Inflation's sticky, consumer confidence is waning.
The consumer is depleting their savings.
What allows you to remain bullish stocks?
Profits are going to continue to be strong. We have an entire generation of investors that do not understand stocks can go up in a rising rate environment.
The consumer is decelerating.
We think that U.S. profits are going to continue to be strong. I think the move back this week to U.S. stocks and the stability that the U.S. market's shown, considering the atrocities that the world is watching in Israel, shows you once again that. I think what investors need to understand is that rates are going to be higher for longer. We already know that. If you look at global financial crisis numbers in terms of risk return, in terms of performance for the market, it is at least 300 basis points higher than post the great financial crisis when interest rates are going down. Interest rates go up means the economy's okay. We have an entire generation of investors that do not understand stocks can go up in a rising rate environment. Go back in history, since 1950, if you look at when the 10-year Treasury goes up between 50 and 100 basis points, that is the best return scenario for markets, period. It's very clear to us in our great economics department that we're not going to have a recession, we're going to have a soft landing, and we're not going to have 2 negative quarters in a row. And we're going to get through this. So I think a lot of the negative rhetoric, quite frankly, in this waiting for Godot-type recession talk that's really been in place for several months has really been misguided.
Yields are going up for the wrong reason. So typically when yields go up in history, it's because the economy is strong. So that you have strength in the economy, yields go up, economy weakens, yields come down. One of the issues that's going on right now is that yields are going up because of 2 facts. One is the Treasury supply, which we've been talking about for the last couple months. We think it's a big deal, and that's only going to get worse. And the second thing is due to inflation. You have conditions there tightening fairly dramatically. They've moved up 90 basis points in the last few months. Oil is up for the wrong reason. It's not up because of demand. It's up due to supply issues. So that's another headwind right now for the economy.
Oil's lower than where it was. We're producing more oil here than we ever have before.
That's true, but oil is up about 30% in the last 3 months, so that's still a shock to the system. And the dollar has had a big move. That's also tightening conditions, and it's happening as the consumer is depleting their savings. We heard that from J.P. Morgan today, right? Jamie Dimon said the consumer savings are declining. Citibank said this morning said the consumer is decelerating, and we're in late cycle. So we are in the latter part of the cycle. The unemployment rate, which is at a historic low, and the nominal GDP growth that we've seen during this recovery. It's grown by about 40%, which means you're at least more than halfway through, and you're probably closer to the end. So this is all coming together simultaneously while you have valuations that are extremely high. It's not like they're pricing in a slowdown in the economy. And so I think it's a pretty difficult picture. And at last point I would make is just that I think this Mideast situation is kind of showing that when you own equities, you are taking risk. And as a result, you need to have good upside returns in order to justify that risk, because there are things that come out of nowhere, like this situation.